The banking sector has been crashing recently. We've had 3 banks go into receivership in the last 2 months, and this has caused a lot of concern over how much credit banks are going to be giving to their customers in the near-term future. Let's talk about how this insolvency is going to affect us and the economy, and how this credit crunch is going to hurt the economy in the near-term future. After years of having a very low credit requirement in order for you to get a loan, banks are changing, and they're making it harder for you to get loans. One place we can really see this at is in the car market. If you care to listen to any of the many YouTubers that own car dealerships, you're going to find out that car dealerships are not able to place people in cars like they previously were. And that's because these loan requirements are getting tougher and tougher. Number one, these banks are making it so you have to put down a down payment. And that's something that's a little bit new. We haven't been seeing that. On top of that, interest rates are going higher and higher, and that's when banks make the most amount of money, when interest rates are really high. One of the main reasons for all of these requirements now is that banks have less money to lend out, and that's because their depositors are taking their money out of the banks and putting them in larger banks, or they're putting them in treasuries where they're getting a higher return than they would at their normal bank. These banks are worried that if they continue to lose deposits, they're going to run out of money and they're going to go bankrupt, and that's a problem. When a customer goes and deposits funds into a bank, that bank then goes and takes some of that money and lends it out to people. But with the rest of that money, they take and invest it into a bond. That bond is giving a specific yield and they're also getting a specific return on it. But as interest rates have increased, these bonds are becoming less and less valuable because they have a way lower return. That's causing banks to not make money on these bonds. They're actually losing money when these people go to these banks and require their money back. Then they're taking this money and putting it into a different bank. And that's because they're worried that their original bank isn't going to be solvent and isn't going to have enough money to pay them back. Now, most people don't need to worry about this because they have less than $250,000 in their bank account. But some corporations do have to worry about this, and they have a lot of money to be moved, and that means big losses for these banks. Then on top of that, if people forget to pay their car loan or just stop paying their car loan, then that's going to cause huge problems for the banks, as they're going to consistently lose money. Number one, on their depositors leaving, and number two, on these people not paying their debts. That's going to cause major losses for the banks, and that's how they go insolvent. Another thing that banks are looking at is the unemployment rate. And although it's low right now, the Federal Reserve wants that to increase. And as this rate increases, more and more people are not going to be able to pay their car loans. This is just another point as why banks are requiring down payments. They don't want to be missing out on this profit, and they don't want to lose money on cars, as they're already losing money on the long-term bonds they bought previously. This is a double whammy for them, and it's causing a lot of banks to go insolvent. The final reason that they're requiring down payments is most likely because car and house prices have gone up dramatically in the last couple of years. That means as they've gone up, something has to give, and they're going to come down. And that's mainly because interest rates are so high, which the Federal Reserve has set, and they want to happen. They want a slowdown in the economy, and this is one of the things that's definitely going to slow down. Banks know this, they're smart, they're not going to continue to get hammered and lose a ton of money. So they're taking protective action. They're requiring down payments. They're only giving money out to people with good credit. And those two things can help them not lose as much money and hopefully stay out of insolvency. And you might be thinking, well, banks have unlimited money. There's no issues. And that's not really true. They don't have unlimited money. They have a finite amount of money based on their depositors and how fast those depositors put in money or take money out of their accounts. The other thing is you might be saying, well, the Federal Reserve doesn't really want unemployment to go up. That would be bad. Well, yes, that is bad for the economy. It's good for inflation. And they're working to fight inflation right now. One other thing to think about is that unemployment is at 3.4%. They want it to get up to 4.5%. That means that more than 6 million people will have to lose their jobs in order to get to that level. That's a lot of people losing their jobs and potentially not paying their mortgage or their car payment. Leave a comment below if you guys think the Federal Reserve is doing a good job by raising the federal funds rate and therefore trying to get unemployment to go up and slowing down the economy. On top of all of this, the Federal Reserve isn't done yet. They just raised the federal funds rate by 0.25%, and it's now at the highest level it's been since 2007. Although after this, it seems likely that they're going to pause, but that doesn't mean they definitely will. We'll wait to see what data comes out next with CPI, PPI, and the most recent inflation data to give a good understanding of where they're going and what they might do. More than likely though, they're going to stop and pause so they can get an understanding of how these interest rates are affecting people. And that's because they want it to affect people, but they don't want to cause a hard crash in the economy. We've heard Jerome Powell say multiple times, we want a soft landing. But is that possible as they continue to raise these rates higher and higher? I'm not so sure. And obviously the banks aren't so sure either, because they're taking preventative actions to try and mitigate some of their risk. Now finally, how is this credit crunch bad for the economy? It seems like it's only bad for people that don't have good credit or enough money to put a down payment. And that's kind of true. Number one, the Fed's already put a credit crunch on the economy. And that's because as they've raised rates, they've made it harder and harder for people to make their payment. That puts a credit crunch on the economy by making less people available to make that payment. Now, banks are being more cautious of who they're lending money to. So now they're making it that you have to have a higher credit score and that the rates will be higher in order to mitigate some of that risk. Again, these are all things that make it harder for people to get new loans, and that slows the economy way down. At the end of the day, the Fed did their job. They're putting a credit crunch on the economy, and now the banks are doing theirs. So the 5.25% federal funds rate that we currently have is actually going to start feeling much higher as banks put on their own credit crunch. Right now, it might be felt as 5.25, but in a few months, as banks make it harder and harder for people to get new loans, that 5.25 could feel like 6.25, even without the Fed raising their rates at all. Overall, we need to understand not just what the Fed is doing, but what banks are doing as well, because it's going to have a drastic effect on the economy. If you guys enjoyed this type of content, hit that like button and subscribe to the channel. Otherwise, I'll catch you in the next one.